Most beginners approach the stock market hoping for a jackpot. They buy a random stock, cross their fingers, and watch the screen. But extracting consistent profit from the market requires you to stop treating it like a casino and start treating it like a methodical job. Today, we are going to build a strict, rule-based framework designed with a single mathematical target, generating 1,000 rupees in daily profit through intraday trading. Before you place a single trade, you need the right tools in place. That means an active Demat account and enough starting capital to absorb minor, calculated losses without wiping out your balance. Having the capital is only the first step. This system relies entirely on your ability to execute predefined rules without letting panic or greed take over your decisions. By removing human emotion and relying on a strict mechanical checklist, we can filter out the noise of the market and turn daily volatility into a sustainable, predictable income stream. Your work begins before the market even opens. Instead of scanning hundreds of tickers, you need to narrow your focus to a strict watch list of just 2 to 3 specific stocks. To qualify for this list, a stock must have 2 things: massive trading volume and liquidity. You need to know that the second you click sell, there are thousands of buyers waiting on the other side. Stay entirely away from penny stocks. While they might offer the illusion of rapid gains, their low volume means you can easily get trapped holding shares with no one willing to buy them when the price drops. Stick to the highly active large-cap names. To find these active stocks, review early morning financial news. Look for companies announcing earnings reports, major acquisitions, or significant sector developments that will drive high momentum throughout the day. By drastically reducing your options to a few highly liquid names, you eliminate decision fatigue. When the opening bell rings, you aren't guessing where to look. You are ready to execute. When the market opens at 9:15 a.m., your first rule is to sit on your hands and do absolutely nothing for the first 15 minutes. The opening bell triggers a chaotic rush of orders based on overnight news and pent-up demand. Prices swing wildly, making it nearly impossible to read a genuine trend. Instead of guessing during this turbulence, let the market establish its actual direction. We wait for the dust to settle so we can see where the institutions are moving their money. At 9:30 a.m., look for an entry trigger. We want a clear trend breaking the opening range, marked by a solid candlestick. But one isn't enough. Wait for 2 or 3 consecutive green candles. Once the pattern is locked in, place your buy order. Skipping the unpredictable opening minutes protects your capital from erratic spikes. You let other traders take the early risks, and you step in only when a confirmed wave is ready to ride. The moment you enter a trade, you must already know exactly when you are getting out. Apply the strict 1% stop-loss rule. Buying a stock at 1,500 rupees means immediately registering a stop-loss at 1,485. That exact drop is your hard boundary. It mathematically caps your downside, ensuring a single bad read cannot wipe out your account. Setting this automated order takes the decision out of your hands. It physically prevents you from holding a plunging stock while hoping it eventually recovers. Hitting a stop-loss is a routine part of doing business, not a failure. It is the necessary mathematical barrier that keeps a minor, temporary setback from turning into a devastating loss. A common mistake beginners make is trying to hit their entire 1,000 rupee target in a single trade. You do not need to catch a massive price surge to reach your goal. Instead, we use momentum trading. We enter and exit multiple, quick positions throughout the day, extracting small but highly probable profit margins from the market. We build the target through accumulation. A successful morning trade nets 300 rupees. A midday scalp adds 250. One final afternoon move brings in 450. The target is hit, piece by piece. Securing micro wins keeps your exposure to the market extremely brief. It drastically lowers your overall risk profile compared to holding a single position and praying for a massive spike. Now comes the hardest rule in the entire system: knowing when to walk away. The moment you hit your 1,000 rupee profit target or reach your daily loss limit, you must completely close your trading application. If you stay logged in after a loss, the urge to revenge trade will take over. You will break your rules, abandon your stop losses, and lose even more capital trying to win it back. Your next step is to prove you can follow these rules. For the next week, run this exact routine with minimal capital. targeting a micro goal of just 100 rupees a day. Build your mental muscle memory first. The mechanics of intraday trading are straightforward. Entering orders and reading charts can be learned quickly, but mastering your own psychological impulses is what determines if you survive